Of the three monetary policy announcements this week, the Bank of Canada's is the most important. Back in April, the Bank of Canada set the ball rolling by becoming the first major central bank to cut bond purchases. They followed up with an additional policy normalization move in July and are now expected to do so again in October. Over the past month, dollar CAD has fallen 4.5% as the Canadian dollar soared against the greenback. There have been a string of positive economic reports, including the unemployment rate, which dropped to its lowest level in 18 months, manufacturing activity, which accelerated, retail sales, which increased, and inflation growing at its fastest pace in 18 years. Data like this has investors convinced that the Bank of Canada will taper in October and end quantitative easing in December, especially after Bank of Canada Governor Tiff Macklem said inflation could be more persistent than expected. Yet, the Canadian dollar is falling and not rising ahead of the Bank of Canada rate decision because what matters now are rate hikes. Investors can see the end of taper, but at the last meeting, the central bank said rate hikes won't happen until the second half of 2022 at the earliest. Now, interest rate futures show the market pricing a full quarter-point rate hike in April of 2022, which is more aggressive. And the sell-off in the Canadian dollar versus the greenback, or the rally in dollar CAD leading up to the rate decision, reflects uncertainty of whether the central bank will actually address rate hikes this week. If the central bank even teases the idea of a first half rate hike, dollar CAD could retest 3-month lows, but if they fail to do so, dollar CAD should rally in disappointment.